This is where most of the meat is at. This is where most you gotta know most of it. Like we're trying to say, I'm just gonna create this ledger, and I want as much automation to come hit the ledger as possible. Right. So if I were, I want the guy on the dock to do the RF gun, hit the material, and they hit post goods issue with a button. Boom, hit post goods issue, and it automatically records. So that's where, and when you do the type of sales entry, is it automatically hits the counter. When you any movement, you can identify the type of activity that's going on in the company. You want to have it on. Now, then there's some things that are just manual, like. But even though there's modules in the system that can handle it, like SAP has a treasury module for loans, so you can go and buy interest swaps, foreign exchange swaps, um, loans, installments, CDs, and it'll automatically post to the ledger. Now, if you don't implement that module, then you just manually record an entry to replicate what the loan postings would be, or like leasing. Leasing is a unique thing that we created those account determination rules so that it'll automatically hit the ledger for all the cash flows, the payments, and the leasing module. You want that module to hit it. But there's all kinds of modules that are coming from SAP that automatically hit the ledger because the ledger is the central. Uh, it represents what has happened financially. What's happened. So you got all these different modules. Come HR module, a sales module, a capital spending module, fixed asset module, lease module, loans, treasuries, MM, production, you know, and they're all coming through the ledger. And this is the integration points where it has the most value. You got to know the integration points that are coming from the different um, different modules, and they're very similar in nature. So if you really know one, how it's really structured, it's transferable to the others. It's really transferable. So if you just if you really understand how the postings on the sales side come through, you really know how to on the purchasing side. And then if you see how they're coming through with electronic bank statements come through for Cash App, you really know how to configure any one of them come through. Because that concept is used, maybe it's a little different language here and there, but it's still going to use overall the concept is still going to be the same. So now we're talking about postings. We talked about how to get data off, about how to create the master data, and how to record the transactions, both automated and manual. This is sort of an automated one, right? So here, this is I can say, okay, FBKP. That's one way. OKB9. But this is telling you all of the places where like automate. These are the tables where the automatic postings for the different places that it's coming from. You know what I mean? So if you got this is where the real meat. This is where you would get your. Nobody wants to post manually to the ledger. Nobody wants to post manually to the ledger. They want everything to be automatically coming to the ledger. Now, unfortunately, you can't do 100%. They got to do some entries that are that's coming through and hitting manually, like accruals, accrual adjustments, and clearing and things like that. That's you use an automated clearing. They want the clearing to be automatic, right? So here, each one of these has a unique appeal. So you look at this transaction. So these are going to be talking about automating. They're going to have. Hey, so when you have a pricing procedure on the sales side, pricing procedure is going to look like a spreadsheet. It will look like a spreadsheet. row 1, row 10, row 20, row 30. I'm just going to say, okay, here's row 10 is the sale price. Um, row 20 is the cost. Row 30 is the net. Row 40 is some uh, extra charges. You know, row 40 is taxes. And then you just say, okay, taxes, you would say taxes, row 40 is taxes. Taxes is 3%. And you say 3% from, go get this 3% of line 10. That's like 10 is the sale price. The tax column is, the tax one is 40, and it's 3% of line 10. It's just like a spreadsheet, just saying, hey, if you look at one, it's just a spreadsheet of rows and columns, and saying, okay, and if you want something to do, but what it has, it has conditions in it, like a pricing condition, like we saw on the purchase side. Sales side has the same condition: sales condition, cost condition, bad debt, accrual condition, uh, expense condition. It has a condition record. And so, in each one of those conditions, you can tell each condition, you give it an account key. And then you assign, so each condition, if it's a real condition and not a statistical, you're just doing it for tracking. Or you use it to calculate, like uh, add these two together and then multiply this one. It's a statistical condition. You're just using it as a statistical to calculate another real posting. So you put an account key on every condition, and then you assign the account key to the ledger. And it's just basically that simple. So you got a pricing procedure is going to have a bunch of conditions. It's going to look like a spreadsheet, but it's calculating the rules, and they're going to be embedded in their automatic postings. And so, and that's the same concept on the payable side. Condition, account key, which is a three-digit key. Okay, you would say sale price. Then the system says ERP is the account key. And then anytime there's a price, it's going to always have ERP assigned to it. If you always anything that has ERP assigned to it, it goes to revenue account. And you just say, okay, prices. The price is the condition. The account key is ERP, revenue, and here's the GL you send it to. And that is coming in the mapping. So anytime that condition is used, you want it to post here. The more conditions you have, the more account keys, the more refined you can put to the different ledgers. So if someone wants to have 20 different conditions, you can have 20 different account keys, and you can point to 20 different ledgers. And then it'll just point to 20 different ledgers. And that will be the assignment, of that. Now that account key, some may call it posting key, some will call it account key, some will call it a different naming. They will give it different mods will give it a different name, but the concept is still the same. A condition gets assigned the account key, posting rule, and you assign it to a GL ledger. And these automatic tables represents what's in them. So if you drill into that table, it's going to say account key ledger combination goes to this ledger. And then each one of those has a different function for each. It's an automated posting for different functions. So each one of those tables has different functions. So now and so now this is now what's a special GL?
Special GL indicators is listed on like 5 or 6 of them.
Now what's his main purpose?
It's an alternative. Don't use the regular GL. Use this one instead.
Yes.
Or that, what was it? Not down payment. Security deposit. Is that one of them?
Yeah.
Special GL indicator, security deposit. There's I got the list.
Oh, but they can be anything. They can be anything. But here, so they don't have to necessarily be. But what they're really used for is that when you have a customer, when you have a vendor, it's for subledgers accounts, customers and vendors.
Value dated bank transfer, is that one of them? Mm-hmm. Value dated bank transfer.
Yeah. But what is that? So it can be whatever the customer really wants. So you can create another 20 of them. Here is the what real main reason for this. When you have a customer and you have to sign a ledger to the customer, right? You have to sign a ledger when you go and create a customer master. On the customer master, you have to sign the reconciliation ledger. Every customer has to have a reconciliation ledger signed. What that means is that anytime you debit or credit the customer, it automatically records to the ledger that customer belongs to. Like you would say, all the customer belongs to the accounts receivable account. So anytime you put a invoice or a payment onto that customer, it increases or decreases the accounts receivable account because the customer is the sub ledger to the accounts receivable ledger. So all customers are sub ledgers to the main ledger accounts receivable. You can have other customers, domestic accounts receivable, international accounts receivable. If the customer's international, you can actually put customers to your different accounts of reconciliation accounts. So you can have 4 different reconciliation accounts, and you can divide. I want So when I see my receivables, I can say, here's all domestic, here's all international, or those kinds. So those two, or here's the intercompany, and here's intercompany domestic, and here's intercompany foreign. You know what I mean? And then the customer that, based on their address or location, you can point them to receivable accounts. So customers are sub ledgers to the main ledger. Let's just take one, accounts receivable, right? That's that's traditional, right? So just this when you say an alternative account, like when you see the alternative accounts, you're saying, okay, don't go to when you hit the customer, don't go to the normal AR. Direct it to the alternative account. So normally I would go to this customer and I'll hit the customer and it's going to automatically go. If I don't, it's going to automatically go to the accounts receivable. But if I want this one customer master and I wanted to have this one customer master and he represented receivable, but he also represent prepayments. So I hit him for some prepayments. I hit him for some alternative ledgers. So I can have multiple ledgers. The customer can be a sub ledger to multiple ledgers. So not only he's a sub ledger to the accounts receivable, he can be a sub ledger to accounts payable, right? So, or he can be a sub ledger to another account, like security deposit. Like so, for example, is one of the examples of this is a security deposit. So I got a section called AR. I got another section called security deposit. It's an asset because the security deposit is say, I'm going to get the money back when the time is over. I get my security deposit back. So I want, and it's for this customer. This customer has a security deposit. I got to get it in this customer. Is my accounts receivable, but this is the same customer, but he is represented in 2 different ledgers. You use the special geo indicator to say when you put the posting key, it says debit. You put the special geo indicator. You says, oh, don't go here normally. Go to this other guy. And you're just saying, okay, redirect the posting from its normal one, which is which is the one you assign to the master record. You say, instead of going to this normal accounts receivable, use the special geo indicator to say, oh, this is a security deposit, and it's going to take it and redirect it to the security deposit. But now when you look at the customer, you're going to see both ledgers. Look at the customer, you'll see both ledgers. The customer's in both ledgers because one has a special geo indicator and one doesn't. But both have a posting key one. One has, but just so it just redirecting it to the alternative account. And you can do that with customers and vendors and ledgers. So you can do it with, so you're only the special geo that says, hey, don't go here, you're a special case. I want you to go to another ledger. And you use a special geo indicator. Now, you have to tell each special geo indicator, you have to assign it to the account. So it has to know, that's where you go to the config, you say, here's the alternative accounts for these special geo indicators. And you just redirecting it to the different ledgers. In case when somebody uses it, it's going to go to the special deposit bucket. It's going to go to the prepaid bucket. So for example, when you have when you prepay a vendor,
Mhm.
you normally prepay a vendor for that's an asset.
Yes, yes.
Yeah, because you prepaid him,
Excuse me.
and if they don't perform, you get the money back. So it's an asset. Like insurance. Prepaid insurance is a asset. You paid a vendor. The vendor normally rests with the accounts payable on the liability side, right? In the 200,000 accounts payable account, you got all your vendors tied to it. I want this vendor. He asked for a prepayment on some insurance. So the prepayment is for a year of prepaid insurance. That's an asset to you because if they didn't perform the service, you get to get it back because you prepaid in advance. And so each month, as the insurance is paid off, you get the expense each month of it to the P&L. But it remains the asset until it's used. So you can put prepayment insurance. So we have a special indicator that says don't go to the payable, hit the asset section. So a vendor can be both on the asset section in the prepayment and on the accounts payable section. Now, and of course, these posting keys is is controlling how you put data on the record. Because like a 40 or 50. A 40 is the general ledger posting, and the 50 is a debit, and then a credit is a credit general ledger posting, and it has 100 different options. You can require, suppressed in the posting keys, just like the special GL indicators. So you can have this is a O1 posting to a customer is an invoice, and you can say that invoice has certain characteristics on that thing. So it's still controlling how data is getting onto the record. You're just controlling how data is getting onto the record. And all these different fields, if you go into that table, it's going to tell you all the posting keys. And the posting key is only used by the master data. I mean, or when you got to have a posting key for everything going to the ledger. So all customers has a group of posting keys. It all starts with a 0, 1 through 19. And those are customer debits, all different kinds of customer debits. And then you can have 21, no, yeah, then 21 to 29 is going to be a different kind of, I think it's, customer credits. And then you have 31s to 30, will be vendor debits and vendor credits. You get 40 is general ledger debits and credits. Then you're going to have 70, which is fixed assets. 75, which is fixed assets debits and credits. Then you're going to go on down to material master debits. They're in the 80s, debits and credits for material ledger. But each one is going to have a set of. If you look at them, you see, the the number range. It says, okay, when you do an O1, it's always a customer invoice. When you do a 31, it's always a vendor memo, credit memo. You know what I mean? So actually, so when you so and it's telling you how you should post to the customer vendor, how the transaction should get on the record, how the transaction should get into the ledger. And it really is a ledger concept. It would be a ledger. A ledger is how you get data onto the ledger and how you get data off the ledger is really the concept. Reporting recording transactions, how to get things on the ledger, and, and reporting is how you get things off the ledger. Report off the ledger, and then posting key is how you control the data getting onto the ledger, and posting keys and documents and how you get stuff on the ledger. And so now the config, this is config data that is controlling how the user use that data, interact with the master data. Now this is the meat. This is where knowing these things and how they're controlled. Like if you go into doc types, there's certain fields in each of the doc types. Each field on the doc type screen does something. So not just doing doc types, but it's each field in the doc type is controlling the entry. Each field on the posting key controls the entry, and you knowing which fields controls what. That's where the meat is at, or the meat is at, or especially how you control the entry. How you control the entry. How to automate posting. How you control the entry to get it automatically into the system. Clearing procedure is how you control the clearing. When you go to clearing procedures, so if you look at those, if you go back, this is the table that has them, right? Okay, so this is this automatic posting config. If you were to do which every one of these is doing, it's really using the account key. So if these are the account, these are, when it says transaction, these are the account keys. So this account key is going to be tied to some kind of condition, and they're going to ask you to put the when you got this check, there's an account behind it. There's a ledger behind it, and it's going to say, do you want the debit to go someplace than the credit? If you yeah, see here. So it's taking the account key and then it's evaluation, but you're giving the debit and credit. You can see, so these are the account keys. And let me just from this is material master. This section here is called valuation. This valuation section is so when one of the first rules you have to define is how you're going to evaluate inventory. How you're going to value inventory. It gives you two methods of doing and how you evaluate inventory. At the company code level or at the plant level. Okay. So that's why they give the term valuation, because it can be either one. They didn't call it plant. They didn't call it company. They call it valuation, because it could be at the company level or at the plant level. So what does that mean? You got inventory for a company. Inventory. You have a plant. Do you have multiple plants? So you got two plants for the company. Plant A, plant B, one's in Seattle, one's in New York. The cost structure in Seattle is different than the cost structure in New York. So you typically, most of the time if you got one-dimensional company, you're gonna have one plant, and you can probably make it. But the valuation is going to be at the plant level, because at the lowest level. So because the cost structure at a plant can be different. You want the cost of this plant to represent the cost of that plant, and the cost of this plant represent the cost. But if I were to evaluate at the company code level, then they both have to share the same cost, but the structure could be different. You could be paying $5 an hour for labor in Seattle and $15 an hour for labor in New York, and so the prices will be $15 higher. And you know what I mean. So the inventory that is sold, the cost of goods sold out of New York is going to be higher than the cost of goods sold out of Seattle. But if you combine them, then you're punishing one and relief and burdening one and giving relief to the other. If you combine them and made it $10, so $10 is the cost because you combine Seattle and you combine New York into one consolidated cost of goods sold. But what you really want is you want to make sure New York has its cost structure and gets evaluated appropriately, and you don't burden Seattle because it has a lower cost structure, and the margins for its sales could be, higher compared to. So you want to, so you would shift more activity there because the cost structure is better. Um, so valuation means how you value it. And anything with two choices: company level, plant level. 99% of the time, plant level. You want to value it at the lowest plant level, and so on and so forth. Now, so you can see when it's blank, it's universal. All plants is applicable. Then that's only for that one plant or the evaluation. Now I can tie multiple plants to that one evaluation area. So if I can create this value, it's called a valuation group. So I put the valuation group. I can say, oh, every plant has its own valuation group. I can say each plant has its own valuation group, or I can say all plants has the same valuation. This is only pointing to the ledgers. So I can maintain one group. All plants can have the same accounting rules. All plants have the same account. So I don't have to maintain an accounting rule for each plant. Well, I can give the East Coast a different accounting rule. That says all plants on the East Coast. I can go to the East Coast group. All accounts, all the plants on I can go to the West Coast group, and then I can give them the West Coast group a different accounting rules. But typically, you would give them sign all companies to the same evaluation group. But this is all. If you open it up, it's an evaluation group, and the plants are assigned to this evaluation group, and so that means that all the potions are going to be treated the same for each one of them. And you can see how the okay. So then you're basically saying now what kind of inventory you have. At different, you have raw material, you have packaging materials, you can have chemicals, you can have powders, you can have whatever. You know what I mean? Uh, how do you want to, how your inventory is broken out? Raw, whip, finished goods, packaging. However your inventory is characterized, you just have these groups here. These are just saying this is finished goods, this is raw materials, this is trading goods, this is raw. So these are just so every time you create a material master, you have to give it one of those groups. So if it's a car, let's say if it's a fender, you give it a raw. So all fender. Let's say you got a motor, you're doing you're doing auto parts or something. All motors are going to be this guy. All tires are going to be that guy. So that now they're going to be treated the same. All tires, but you got to put it on the master record. You got to put the account key, that key, just like a condition. So it's like a condition. Like if you use a sales order, the master record. So it's going to follow that master record everywhere it goes. So you will say this is raw material. It's a 3,000. So every raw material, whenever somebody creates a raw material on the accounting view, you have to give it a raw material grouping. And so all raw materials are going to take this accounting. And then these are all the account keys. These are what we're talking about, the account keys. So this is like, okay, so this is just describing the type of activity. Like if it's a production order, it's a sales order, it's a goods receipt, it's a goods issue, and then each one. Then so this is saying if it's a goods issue and it's this type of material, then use that ledger. If it's a goods issue and it's that material, then use that ledger. You know that this is where the meat's at. So, but once you set it up, because how do you make that happen? The users don't see, they don't know how to do this piece. How to create the automatic postings so that anytime this movement in the inventory occur, you already got it mapped. Nobody has to post. It's usually tracing movements 101, 102, 601, 602. Another one. These are trailing the inventory movements. And this is mapping every one of them. Now, there's a cheat sheet for every one of these keys. So it says, oh, BS. This is what this movement does. These are SAP delivered keys, and you can have. So here's a cheat sheet for all these movements. And this one here is for production orders. This one here is for sales orders. This is here for what I mean. When sales orders are increased, there's one when sales orders are decreased, and then you would have this is where the integration points between material management, production is right in this section, and you'll see GBB and all that. Start seeing them. So the GBB is at a higher level. It's one level higher. There's a bunch of other ones at the same level of GBB. So GBB is just only one. This is only talking about GBB, but there's another 20. So you just hit GBB, but here's all these other ones. GBB is the offset to the inventory posting. So you can see the offset to the inventory posting. So offset to the inventory posting is all these other sale. When you offset inventory, you're either going to have a sale, you're going to have a production order, you're going to have a movement, you're going to have an increase in inventory, a decrease in inventory. And you're doing it in all kinds of ways. So that's just GBB. You got all of these freight. You got freight costs. You I hit that? This is a touch screen?
No, it's not.
Okay. So if you were doing consignment payables, you'd be in that guy. If you're doing prepayments, you could be in that guy. If you're doing freight provisions, you could be in that guy. Customs, if you have customs, you're doing stuff for customs, you have that key assigned to purchase orders. You have this account key on a condition in the purchase orders for customs, and you assign that key. Back in there, when you drill into that, it's going to be asking for a ledger, just like that GBB is asking for a ledger, right? And then you assign that to a condition, and so on and so forth. But you can see all the different kinds you can have. Exchange rate differences. If you have, this is where it's going to go. External activity. If you have external activity, you assign that condition, that account key to the condition for it. You will put a GL behind that. That concept is everywhere. And that's where the most bang for the buck is, understanding these tables. And sales distribution one, look, you've probably seen the one on sale. This is an inventory. The one right here is inventory because this is that group. But there's other, and then,
Yeah, it made the point that FBKP had most of the automatic account determination, but not for sales.
Not for sales. Yeah. Not for sales. It had quite a bit, and it doesn't have the lease ones. It doesn't have the bank statement ones. It doesn't have so each one of these models have their own. This is mostly for inventory, which is a nice chunk of sales and inventory. Nice chunk. A lot of people don't implement these modules. Or fixed asset has its own. You look at the fixed asset has its own tables, not this one, but it has the same concept.
Yes. Okay.
That it'll tell you a place where to put the GL at and the fixed asset thing. But yes,